This is not good. Shoot.
How we doing now?
I can hear you. Ooh. Are we live?
We're live, yeah. Hi,
Okay.
Bill. Can you hear me, Bill? I can hear. Sounds good. Getting lots of positives. But I'm trying to get Bill's attention by talking. Can you hear me? Wave. Say hi. Art, you and I can talk?
We can.
All right. So let's rock and roll on that. And Bill, if you can hear me or if you can't hear me, just log out. Try logging back in again. We had some technical issues with our server. It looks like with getting people in and out, it should correct itself now. So just close your browser and pop back into that link one more time. So Art, let's just talk you and I. You're at Prologis. Prologis is probably a busy place right now. You're probably happy to be the darling of the stock market, I suppose, somewhat. My 18-year-old son just bought $500 long on Prologis. So I think that's a good sign because he has no idea what he's doing. And if he's heard of you and thinks it's a good buy, then I think that's probably a good move for y'all. So just tell us what's up, Prologis. What are you working on, and a little bit more about your job and what you're doing.
Sure. We're definitely in the right space, and I like the trend. We have seen this shift towards more online spending for a long time, and the pandemic has just simply accelerated that trend. So, great spot to be in for anybody in this business. And Prologis is the world's largest developer in this space. It's the pedal is down. We had obviously a little bit of a brief pause back in April. I'm not sure where the economy was going to turn, but as we quickly learned, the lifeline really for everybody was being able to purchase online, and no question about it, it's been a huge tailwind for our company and for the space in general.
I don't know if you can see the comment from Jeff Pappas. For what it's worth, I'm in proposal stages with the Prologis site in Pennsylvania. Can you help me? Maybe offline, Jeff.
Good morning.
There we go. Hi, Bill.
Greetings.
Push your webcam button one more time. We'll be able to see your face. All right, so it's your turn to do a quick intro, and let us know what you're up to at your job, where you work, what's going on. What's the latest?
Yeah, good morning. I work at Rubicon Representation. We are a boutique tenant rep firm here in Dallas. We service clients throughout the Dallas area as well as the nation. Our focus is on primarily industrial and healthcare companies, as well as office users. I've been here in Dallas about 35 years, started in the banking business, entered the industrial space about 30 years ago, and spend most of my time in warehouses throughout Texas, helping people locate space and procuring industrial storage and distribution facilities.
Okay, I'm in the background here trying to get Tom logged in, our third speaker. Tom's from Hillwood, and I promise you at some point we'll get to hear his voice. But let's go, Art, let's just dig right in. I've got a question for the two of you specifically, as soon as I can find it. How to anticipate emerging tenant needs. So we just had a panel talk a lot about tenants and what's going on in the particularly Dallas-Fort Worth area, northern Texas area, and what their needs are. So what are you all doing to try to get ahead of these tenants and anticipate so you're building in the right spot, right time, right product?
You know, I'm happy to start with that one, Bill, and maybe you can catch the back half. You know, certainly if you start with the consumer and work backwards from there, people are impatient. You know, we want our items quickly. We don't want to wait. We don't want to drive long distances to go retrieve them. Our preference is to get online and order that way. So, you know, finding industrial sites that are close in, that allow for, you know, efficient, expeditious delivery is going to be really, really critical, you know, now and even more so moving forward. We want quick. You know, that's the demand. And so I think if you focus on locations that really provide that last touch, you're gonna fare well. And I would be, you know, more focused on an in close location and a higher rent than being, you know, further out and sort of the old model where the user base was, the tenant base was really super price sensitive. I'll start with that.
Well, we just heard the opposite though about the outer ring sort of suburban, exurban areas that some of the logistics companies want to be able to pop in and out without having to get into the congestion of a bigger city. So how do you balance that? Are you seeing a little bit of each, or is it more important to have that core close in location?
You know, the Prologis model is close in. That's where our focus is. We do not want to be out in the sticks. We prefer to be really, really close to the consumption base. And our position is better to be you know, prepared to deliver very, very quickly. That's our model.
So is last mile a big topic at Prologis with regards to location?
Huge.
Okay.
Yeah. Amazon's our biggest customer. You know, the 3PLs. I mean, we spend a lot of time talking with our customer base and understanding what they're looking for. And I mean, Amazon, it's an easy company to talk about because they represent, you know, so much of the demand right now. I think we've estimated upwards of 40% of the current demand is tied to Amazon. So easy company to follow, monitor what they're doing in many ways. I think the model for, you know, lots of, you know, folks in that space.
Well, it makes sense. Other people would follow the leader too. Obviously, Amazon's doing something right. Let's piggyback off what their model is. So how often do your tenants, or how often does Amazon or other tenants come to you and say, we need a solution for, whether it's a cross dock or a gigantic facility compared to a last mile facility? Are they saying we need you to get creative and find us, you know, places for the Uber Eats guy to drive by and pick up a package and deliver it?
Yes, certainly we're in those conversations. We have a number of build-to-suits that are going on now with Amazon, and inevitably it's a site that they really want to operate out of, and being creative, I think, is imperative. You know, whether it's, you know, converting old uses. I mean, it's really difficult to find a greenfield site that's close in. Those have just largely disappeared. We don't have many layup sites that, you know, we focus on Dallas for a second. I mean, even 5 years ago, it feels like it was much easier to find, you know, close in sites. But that challenge continues to go up, and the more creative you can be or revisit, you know, sites that have been really challenged from a development perspective, you know, going back, revisiting those, rolling up your sleeves, solving challenges. If you can do that, you'll find oftentimes that the user will come to you because they just want to be in that location.
All right. Oh, I got something on my screen there. So, Bill, let's go to you and talk about what you're doing to get ahead of tenants and stay ahead of tenants in the development cycle.
Well, what I find most interesting, and this resonates with much of Dallas industrial, is that when you look at the city, our fantastic highway system promotes the proliferation of industrials. But what you have behind that is industrial users today tend to be very location specific. And we look at all the growth in the city, which is either North Fort Worth, South Dallas, South Arlington, etc. But what makes that interesting is even though we have so much development there, most of the tenants in the greater Dallas area are very, very sensitive to relocating much more than, say, 2 to 3 miles from their current location. The origin of that is labor sensitivity, because heretofore, and even still in the industrial market where the labor market is very, very tight, business owners are reluctant to move too far because they're afraid that their labor won't go with them. So for that reason, to get ahead of what tenants need today, you have to work very carefully to find locations that will enable them to keep their labor intact. So as we work on these projects, back in the day when the vacancy rates were higher, we had many, many more options. Today, you're fortunate to have maybe 4 to 6 options. And if you do have those options, then you get into some challenges, which is the type of build out, the clear height, what does the truck court look like? Companies today have growing inventory diversity, so they have more SKUs that they're dealing with, which creates storage challenges. So when you look in the paper and you see the big news about where these big distribution centers are going, to me, those are largely out-of-town projects, people that are coming in from other regions or national consumer products type companies, which, of course, all of that makes sense. I think we'll probably talk a little bit more about e-commerce, but on the e-commerce side, the other thing that we're seeing as it relates to tenant need is so many of our clients have added to the e-commerce component of their business, which changes their material handling systems, et cetera, and changes their space needs.
Right, that's definitely been a change. I know for the brick and mortar retailers to add e-commerce and be able to pick up store side, that creates another sort of how is this all going to work in our logistics world? Let's pivot a little bit because we're going to have some questions on other things. Let's pivot back to the first question I had on my list, which is construction costs. So we're looking at the Dallas-Fort Worth market. You're looking at putting up a new site. How are construction costs factoring in? And are the rents able to support it and the terms of the lease? And what's the concern there, or if there are any?
Yeah, I'm going to try to answer that 2 ways. If we focus on the inputs of the construction itself, steel, roof, which is really tied to oil, and of course concrete, the 3 major cost drivers. I just coincidentally I pulled out a bid from 2016. And it was a 300,000 square foot cross-dock facility. I compared it to a 300,000 square foot cross-dock that we're laying out today. And in terms of the material inputs, all of the construction inflation that we've seen over the last 4.5 years was completely gone. And which was a bit of a surprise to me. We've been seeing 2 to 3% annual increases, and looking at those bids straight up, it was absolutely even across the board. So from a material standpoint, that's really good for the end user. What has been really going through the roof is the cost of land. So inevitably that's going to be pushing up rental rates. That's where we're seeing really the impact of what tenants have to pay. It's all 100% a function of land.
And Bill, to you, any thoughts on construction costs or other costs getting the rents and other rents going to get there? Is that in a region where you can do deals?
It's a fantastic question. One of the challenges that we faced through the past 5+ years has been growing finish out costs. As the market has strengthened over and over, the rents have gone up and the improvement allowances that the landlords have been offering have become less. And so as a result, when a user has a need for office space within an industrial property, he's challenged with financing that either through the landlord or out of pocket. What we're seeing is back in the day, you'd see office space in a shell building estimated at $45 to $50 a foot. That number today is $75 to $85 a foot. And in light of those types of numbers, you go ahead and impute that into the rent when you finance it, typically at around 8%, it can add as much as $1 a foot to the deal. So as we work on these requirements today, one of the things that we ask our clients to do is look carefully at their office need within the warehouse space proper. The other thing that's going to be interesting as we go forward is we're still waiting to see how many employees are going to continue to work at home. Decisions in that area seem to be fleeting a little bit. I continue to survey the market of professionals in DFW, and I only know of one company that I've spoken with thus far that's made a decision to leave about a third of their office employee base at home. So when you look at these types of construction numbers, it's a real challenge. The paper suggests, and there was an article even this morning in the morning news about declining construction costs, but it was segregated in between retail, healthcare, and industrial. Industrial construction costs still seem quite high, and I think it's going to be with us for a while.
I'm seeing, we're still, I think, a little bit in this price discovery phase. We don't know exactly what the impact is going to be to, all the construction workforce in retail, in office. It's interesting to me. I've watched, industrial brokers that very successful, active industrial brokers leave, go to the office space. They're coming back to the industrial space. I see a shift for that construction workforce that's, done big box retail, which is effectively an industrial building. I see a lot of that workforce needing to be able to transition back to this space. So we're early, and it'll be interesting to see. My gut instinct is there's going to be overall less development when you look at all of these different sectors, and I think that will benefit pricing in the industrial space.
Just from a materials and labor costs and all that perspective, because you'll be able to pull from other people that would have built a medical building are now focused on industrial.
Yeah, I think so. This work from home is real. I was reading the San Francisco newspaper. Penn Interest had 400,000 square feet of space that they were going to occupy. They've canceled that project. They paid
$90 million to get out of that lease.
That's unbelievable.
Wow, right?
That's an eye opener.
That's a commitment to working from home. Of course, they're tech companies, right? It's a little different than industrial, but it is going to affect other developments going on around Dallas, certainly.
We're really in the tech space. I think the industrial space is really become part of that tech supply chain, and I think we're starting to think like tech companies. We realize that we need to be using all of these technical applications, and we're finding out that working from home is we just didn't have to experiment with it in the past. We're doing it, it's working, and decisions are yet to be made, but I think there will be a component for Prologis of working from home, traveling less. Those will be permanent realities.
Interesting. I would have never thought to hear you say you are in the technology business, but really your big tenants, Amazon, right, is a gigantic tech company. Although they're also a gigantic logistics company as well. Interesting. Well, let's pivot again here quick to this is a good one about controlling and owning land. Past or present nuances, cashing in on owned land. That's always been the fate of industrial developers, right? Is who's got control of that land and how much are you paying to maintain that through a down cycle potentially? So what's the latest on owning land and land banking and what's going on there?
Well, if we look at it from a historical perspective, the A&B Prologis merger really came about in many ways, combination of a downturn and a huge land bank that Prologis had, and you layer in some over leverage with that huge land bank that you need to service, and it really was a big trigger to the merger. So a huge land bank historically has had a bad name associated with it. If you fast forward to where we are today, I wish our land bank, certainly in Dallas, was bigger. It's a great spot to be if you've got a big land bank. We've got roughly about 150 acres that we can control today. But the truth of the matter is, I wish we had gone on a land grab 5 years ago, and it'd be a great position to be in. That's at the end of the day, these users are going to go to the locations that they want, and we have some advantages in terms of the discussions that we have with our customers. We get a sense of where they want to be, but the truth of the matter is, if you're the owner of the land in the right spot, the user is going to come to you regardless of what company it is.
I learned early on, though, when I was a young real estate guy, a veteran of the industry came to me and said, land eats every day, just like a tenant. I thought, well, okay. So I nobody can blame you for not land banking more, especially Prologis. You guys have poured a ton of capital in that. Well, let's go to Bill. What are your thoughts on land, controlling land, acquisition, banking, that sorts?
Well, again, working with business owners, one of the conversations we have regularly is own versus lease. And a sector of the market that I think is particularly interesting is manufacturing companies throughout the area that may be candidates to own their real estate where currently they lease. The question out there then again becomes, where do you go to find that land? And once again, as I mentioned before, it's challenging because you've got to consider effectively a corporate relocation. And I've been a huge fan of North Fort Worth for many, many years. But when you have that conversation with a company in North Dallas and you talk about going out to North Fort Worth, they look at you as if they're moving out of state. Where, of course, when you look at what's happened out in North Fort Worth, it's certainly one of the most dynamic industrial developments in the entire country. And so many companies have gone there, yet I only know of a few Dallas-based companies that would consider that. Equally, if you look at South Dallas, it's the same type of thing. To get somebody to go to South Dallas, I know of one company right now that's looking at doing that in about 2 years when their lease expires. It's just not a trend that's backed up with the evidence of people relocating. But I think that's where the future is. And I think the future is going to see a separation of office and warehouse, where so many companies today have their office headquarters at the warehouse. I think in the future, they're going to have to reconsider and separate those functions so that they can achieve a lower basis. And to the extent it makes sense to own, then going out and procuring land. Another story behind all this right now is the interest rate environment that we're in, where we've lived with low interest rates for such a long period of time. And then the Fed has now recently confirmed that they're going to continue to keep rates down. That's good for real estate. And when we look at the type of numbers that we've seen and the cap rate compression, certainly monetary policy has contributed to that. And I think everybody now is looking very carefully. So when it comes to land banking, if you're a business owner today and you're leasing, I think it makes a lot of sense to evaluate looking at land options and considering taking a position and then planning for future relocation.
Certainly those low rates will help balance any rising costs of land or costs of construction, right? Because your cap rate can account for that. You don't want to be trying to sell a building at a 3 cap that you built to. Well, you want to be doing it if you sell it. Nobody wants to buy a 3 cap that was built to a 6. It's good profits, but those costs balance out. I think more things happen. So let's just talk about then. Sorry, I got off my train of thought here because I'm trying to figure out where Tom went and make sure I'm not asking you all Tom's questions. Let's talk about that. Then what I was talking about earlier, cap rates. So how is this all affecting cap rates, and what does that do to your exit and your entrance and signing leases? How is that the cap rate functioning, and where's that headed?
Well, certainly, I mean, right now there's no yield. There is no yield. We got tons of money in the system, 10-year treasury, all-time low. So that has been a huge benefit to, compressing cap rates. And development projects that maybe haven't penciled in the past all of a sudden are penciling. You combine that with the fact that, hey, we're got this great trend. It's a good space to be in. Finding land is harder. So if you've got a great infill location, you've got very well over the long run, and the chance of rental rate growth is really, really compelling. So you can take what historically is a really low return, but compared to treasuries, it's still a very positive return. And it's just made it easier for developments and spec development, build-to-suits to pencil easier.
I think there's another underlying conversation on the cap rate front, and I completely agree with what Art said. But I think another piece behind this is the underlying credit quality of the tenants on these leases, because of course, when you look at cap rates, you've also got to have credit quality on the exit. And one of the things that's been occurring over the past 10 plus years has been increasing leverage levels at the tenant level. So what you find now is, I think keeping an eye on what the economy's doing. Of course, retail's been hit hard, et cetera. But in the industrial space, one of the things to keep an eye on is how are these operating companies doing? What do their balance sheets look like? And what does that do to cap rates? Fortunately, here in Dallas, the economy is quite strong, but doing work around the country, I'm seeing in some other areas, there's a little bit of softness out there. And I know we're focused on Dallas and Dallas-Fort Worth in this particular conversation. There's certain areas right now where it's not quite like that. And I'm starting to see increasing free rent levels. I'm seeing increasing tenant improvement allowances. We just did a transaction for a client out of market where our renewal rental rate was flat with the last year of the lease. That's unheard of here in Dallas. You're absolutely going to see increases at renewal here. But as I said, we just did one. There was no rent increase at renewal. So is that going to be a growing trend? I think we're all wondering about what's the pandemic going to do, and nobody really seems to know where that's headed. The news appears to be favorable, but I think the next 90 days are going to be critical, particularly as the schools open up and we see what that does to the market.
Yeah, let me take one other shot here that's affecting these cap rates. We've got a lot of institutional money that's earmarked, towards real estate. And do you want to put it in retail? Do you want to put it in office? Those are just really, really, risky investments for the moment. And at the same time, you've got a certain allocation that needs to go to real estate. So I think, putting it in industrial is a pretty safe bet. So those money inflows, I think, are going to have a big impact on our space, for a long time.
We're having connection issues here. I'm trying in the background to figure out Tom and everything else. It's just an internet busy Tuesday. It just tells you what is going on with this world, how much things are changing every day and continuing to evolve into this. We've got a couple questions from the audience here. What are you seeing with assistance from restrictions from city to city and development? This is from Vic Honorio. What are we seeing from the cities in assistance? Well, it's a two-part question. Are they providing capital and or restrictions like truck parking or things like that? What are you seeing?
Just a few markets where I'm working right now is because of the strength of the overall economy. Municipal incentives have been fleeting at best, and the supply and demand equation very much explains that response. Because of where we've been in the cycle now for 10 years, as we work projects around the country, there just really hasn't been that much support. I'm sure Art can probably refer to perhaps some real property incentives that they have on the development side, but representing business owners, we have seen some municipalities do some things on the retention side, but I'm not going to offer up that there's been a lot out there from the cities just because times are good. Art, how about you? What have y'all seen?
Yeah, I can give some maybe micro examples that I mean, it's been an evolving process, and this has been really interesting to me because we've been engaged in some of these conversations. And if you look historically, industrial, it's certainly not a sexy product. It's got big 53 footers that are idling and are emitting all these greenhouse gases, and the NIMBYs. I don't want this anywhere close to me. You always have that kind of resistance. So it's been a very necessary part of the supply chain, but I don't think it's been really viewed as something that people actively want in their city. But if you take the city of Arlington, where a big piece of their revenue is dependent on Cowboy Stadium or the Ranger Stadium or Six Flags Over Texas. If you look at the makeup of their tax base, they've been really heavily dependent on activities that have not been possible for the past several months. And I single them out because they have such a big portion of their budget that's that rides on these kinds of revenue sources. So, and they also have a big industrial component to their base as well. And what has performed really reliably, what has given them the tax revenue that they've needed, it's been the industrial sector. So I think that perception in terms of what cities want is evolving. It's if you look at your stock portfolio, you want a diversified, group of stocks, I would have some industrial in there because it's just going to help give you a more resilient revenue source. And I think smart cities understand that. They're seeing that. They're changing the perspective on that, and it's translating into getting dollars when you need help. It's oftentimes we're working with really challenged sites so that the cities aren't deriving any kind of revenue from that as it is. So if you can get in there, make a compelling case, understand what your needs are, and then really be in a position to say, hey, we're going to attract some really high credit quality customers that will give you business personal property tax. Your appraised values are going to shoot way up. You're going to get a nice property tax component to it. And then the third leg of that stool, in addition to those revenue sources, you don't have a significant strain on city resources. You're not hitting the schools. It's a pretty light use. You've got road impact fees that tend to cover repair needs there, but by and large, these are low impact to city services and a great revenue source. And I think the smart cities are embracing that, seeing that, and in our case, it's translating into some needed help on a few projects.
Well, that's fantastic. And we've got a city panel coming up next, so they're going to want to talk about it as well. Have you seen, so I know the cities are looking at two things, right? Tax revenue and jobs. So can you create jobs for me too, or sustainable, or the jobs that we want or need? And so our last panel had talked about robotics being a growing trend in industrial. Does that affect the number of jobs, or does it change the type of jobs? In what way is that impacting some of this conversation?
When you look at technology, and my background was in material handling before I started in industrial real estate. It used to be that technology was a labor savings equation where you would talk about not requiring people because you have the technology. Today, because of tightness in the labor market, I see this technology more so as a way to make up for what you can't find in the labor market. But there's one underlying theme here that always comes into play when technology is the question, and that is a predictable business cycle. So many companies that have seasonal businesses are in a tough position when it comes to technology, because you can only take advantage of it for a portion of the year, say 6 months or so. So your return on investment is a much more difficult decision. The companies that are the best candidates for technology are the predictable path. Every quarter looks the same year in, year out. And so we're seeing these growth opportunities on technology, yet, as we said before, we not only have rising construction costs, the capital outlay on this type of investment is very significant. So you've got to look out 10 years or so. And so although we're seeing more of it, we're still seeing a lot of the fundamentals where most middle market companies might be exploring it on the software side, but not necessarily on the hardware side.
I've got a few thoughts on the labor piece as well, and certainly we're relatively early in trying to understand how this pandemic is going to affect labor, how it's going to affect building design. There's a number of things that we're looking at. I think about my son this summer who worked at an Amazon facility, and there was a person that was dedicated to their team, making sure that they were staying socially distant. The lifeline of helping us navigate the pandemic were these, logistics facilities, and they were really, really being uber careful in terms of making sure that they weren't having breakouts in the facility. So, cafeterias or break rooms that are bigger, contactless, entry points, just a reshaping of the way that the design is being developed, I think, is certainly understudy. And obviously you take people out of the equation and you've got material robotic, handling equipment to replace some of those jobs. That solves the problem too. But most of the feedback that we've heard is, like Bill mentioned, it's dead on. The return on investment for a lot of those robotic operations is still really, really, really long. So I don't see a huge replacement trend on that front.
Well, we've got Tom in on my screen. It says he's Bill, but are you there and can you hear us?
Can you hear me? I can hear you.
Yes.
Victory.
I was about ready to call it Technology Tuesday and just say that I hope this never happens again. But so, Tom, tell us about you, do a quick intro, and then we want to get up to speed on your thoughts on some of these things. So we'll catch up, but
Sure.
Give us an intro.
I appreciate it. So, I'm Executive President here at Wood and responsible for the acquisitions and dispositions of our portfolio in the United States and a little bit in Canada, Calgary specifically. And again, it's acquisitions, dispositions, and joint ventures. Our portfolio is anywhere from 5 to 30 million square feet, depending on the time of year you catch us. And we're really busy in all those three spectrums.
Good. So just for everybody's knowing what's going on, I'm going to keep your picture a little small. You broke up a little bit there while you're talking. We'll try to minimize the amount of information we're feeding to your computer and pulling back out. So Tom, we've talked a lot about construction costs, tenant needs, but since you're an acquisition and disposition guy, what's going on in the world of industrial cap rates? Can they shrink any further? And how does that look on the acquisition side versus the disposition side?
Sure. On acquisitions, I think you see cap rates at historical lows. We are now below the cap rates that we saw pre-COVID. And a lot of it is due to the amount of capital that's trying to flow into industrial investments.
That sounds crazy. So among the things that I don't understand about COVID, number one, why do we have a toilet paper shortage? Number two, why is the stock market at an all-time high? But now we have to add to that cap rates all-time low for industrial in the middle of a pandemic. How difficult does that make your job? or good
It's
if you're
difficult.
selling.
Yeah, I mean, it's great on the disposition side, difficult on the acquisition side, but there's always opportunities. So you just have to find them. I think a lot of it is driven by interest rates. At the end of the day, most groups will get some sort of financing, whether it's 30% or 70%. So the cost of borrowing, when available, is the cheapest it's ever been. So that's number one. Number two, it's like everything else, it's an investment. So if you can invest your money at the bank and get 50 basis points, industrial at 500 basis point look good.
Yeah. What is the cost of capital now? I did a panel for capital markets, and houses, you're talking sub 3%. Some asset classes, you're talking sub 3%. What is the cost of capital for, let's say, a good industrial project, favorable?
I think if you're to look at 50 to 60% financing or loan to value on a 5 to 10 year term, you're plus minus 3%.
Yeah, that's craziness.
And if you look, yeah, I mean, if you look where some of the REITs trade today, some of the industrial REITs,
yeah,
they're somewhere in that 2.5. I mean, Art can say better than me, but somewhere in that 2.5 to 3%. So it is.
Yeah, Art, what's your cost of capital?
We've been able to, it's the cheapest it's ever been for sure. We've been able to float, money at, 150 basis points. It's part of the scale. The company is extremely low leverage. We're trending at like 18%. We've got a great balance sheet. All of those things really come into play, but it's the cheapest it's ever been by far.
So we only have about 5 minutes left. I want to let Tom we had some bullet points and stuff we sort of skipped around, but I want to make sure you get in on the topics you wanted to make sure you made points on. So just give us sort of the highlights of things that you wanted to make sure you covered today.
Sure. I'll go back to one of the questions on rising costs. I think the most amazing part when I talk to my team, especially here in Texas, is the cost of land. I mean, we've seen it double, if not triple. So that's just a big indicator of where pricing will be. I think then you go to rents, and rents have increased. I think there was a little bit of a slowdown for the last 2 to 3 months, and it was just a pause. So you didn't see rents dramatically drop, just a pause. And now you're seeing activity, significant activity. I think it started with bulk. I consider bulk anything 350,000 and above, and now it's starting to trickle down into the hundreds, and now we're seeing it in the 50,000 square feet. I think Bill can comment on that, but I mean, that's where we're really seeing the activity now, from the 500 to the 50,000 square feet spaces. And then I already spoke about capital coming into industrial. It's just a preferred asset class. So, and again, if you look at it, a lot of these industrial leases today are going longer term. So it's looked at a stable long-term investment where, again, you can get the financing, which we've already discussed.
So the days of $4 rents are gone for good, finally? How many decades of $4 rents did we have around the United States, or maybe 5? But how long does this last then, this really cheap capital? Anybody got a crystal ball? Because I've heard it's going to be a long time.
I think it's here to stay. When you consider where we are from a fiscal standpoint nationally, the rates have to stay low. There's no way that can change.
That's just craziness, though. We were all alive when rates were really high.
Yeah, I mean, the Fed came out yesterday, and I mean, it looks like rates are going to stay low for a while. But again, it's not complete correlation, because at the end of the day, even when rates moved up a little bit, it's not like it's a 1-for-1. For example, even though rates are low, a lot of lenders install floors. So you're always going to pay a minimum, let's call it, a floor of 1%. So it's definitely a big momentum mover. But, low rates are here to stay for a long time, I believe.
We got 2 or 3 minutes left, and somebody just asked, this is great, Vic, how does the election affect Dallas-Fort Worth industrial market? Let's get into politics.
Well,
I'm sorry, go ahead, Art.
Yeah, very, very brief. Traditionally, the market doesn't like uncertainty. And you'll see big decision, being held off. We saw that in Q2. Our industrial demand was really, from a net absorption perspective, relatively light. But then we're going to have a huge third quarter. We're tracking 7 to 8 million square feet of positive absorption. So that pent-up demand is going to be realized this quarter. Are we going to maintain that kind of momentum? I mean, we're plus or minus 60 days out. I don't know. Let me turn it over to the crowd and see if we, I'd love to hear their perspective.
I think things are going to prosper in Texas either way. In fact, regardless of what happens in the election, I think Texas benefits because of all our inherent amenities that we have here at a low cost.
Yeah, I mean, in any other given year, you'd say the election would cause a momentary pause, but I think this year has been so erratic, and you guys probably talked about this when I was having my difficulties, but the growth of e-commerce right now is just so strong. Everybody's trying to catch up to the big gorilla. So you're just going to see, and they are. I mean, all the retailers are so far behind the gorilla that they are leasing space, and everybody's trying to catch up for Christmas. I mean, there's no doubt on that. So I think you're going to see a really strong third and fourth quarter, even though it's an election year.
I put my mute on myself. Tom, you made a great point. Christmas might be more important than the election for industrial and retailers. Weird to see. Well, gentlemen, we've literally can spend 2 more minutes if anybody wants to say final thoughts and goodbyes and anything we missed if we didn't cover. Art, we'll start with you.
Yeah, I'd say I'd add one thing. I know we're talking, election, relatively short term, but if you look at the long term, I like spending time with the Dallas Chamber of Commerce. It's an interesting place to figure out, the number of companies that are looking at moving here. This is clearly a very pro-business state. And historically, 20 to 25 companies are just evaluating the possibility of coming here. And right now that number is closer to 70. So the long-term, trend here in Dallas is going to be phenomenal. We are in a great position.
That's good to hear. Bill?
I agree with what Art said. I see nothing but blue skies for Dallas, Fort Worth, and our state in general. The best is yet to come.
Awesome. Yeah. And Tom, thanks for sticking with us and connecting. It was fantastic. I feel like we won in the fourth quarter, a big overtime game.
That's right. No, and I agree with Art and with Bill. I mean, with population growth and e-commerce growth, I think future is very bright here, especially in Texas.
Well, thank you, gentlemen. Thank you, everybody, for watching online. Go back to the lobby. And Katie made a good point here to refresh your lobby page prior to joining. I assume everybody knows how to do that. There's a refresh button. I always just highlight the link and click it again. But go back to the lobby. We'll get to watch panel 3. We'll talk about cities, municipalities, and continue to talk about DFW industrial development. Thank you, everyone. Happy Tuesday, Technology Tuesday. See you all. Thanks.
Bye.
Thank you, guys.
Bye.